Besant's Treasury coup on Wednesday turned out to be a flop quicker than I thought. But there is more to the story. It is that the US dollar today is falling even as Treasury yields and crude oil prices rise, suggesting that traditional relationships in the market are breaking down today as fiscal concerns and confidence in the US assets deteriorate. So welcome to Swissquote's Daily Market Talk. It's Friday, 21st of August. I'm İpek Özkardeşkaya. Today, I will talk about what the market's response to Besant means for the broader price dynamics in the longer run and more. But before I do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So investors spent yesterday digesting the US Treasury's bold announcement on Wednesday to double the amount of bond buyback that it is allowed to conduct to ease the pressure on the longer end of the US yield curve. The move aimed to address the 10 to 30-year segment of the US yield curve that had recently become subject to a heavy sell-off, remember. But unsurprisingly, the US 10-year yield rebounded to recover all the post-announcement move, and the 30-year yield also retraced half of the post-announcement decline. The idea that Washington today is willing to buy back more debt instead of adopting its fiscal policy, slowing the debt growth in the US while taking control of the Federal Reserve monetary policy didn't sound as great as the first hours suggested when the reality sank in. Zooming out, the latest news will only reinforce the de-dollarization trade that's already in place. Note that foreign entities like central banks, finance ministries, and sovereign wealth funds aggregate holdings of US Treasuries fell to some 12% today from roughly around 40% during and after the subprime crisis. The US deteriorating geopolitical relations and the loss of confidence due to the lack of fiscal discipline in US Treasury were among the biggest reasons for the waning appetite for the US dollar and US Treasuries, and the latest news will only reinforce the loss of confidence. Anyway, with the short-lived enthusiasm around the Treasury's announcement on Wednesday, the sellers returned to the market and sold risk as US crude oil kept climbing on Middle East jitters. There was nothing surprising here really, but what's new is that the rising oil prices do no longer support the US dollar, as a higher US dollar demand that comes with higher energy prices is being outweighed by the selling pressure that we see in the US dollar due to US specific factors that highly displease investors today. So the dollar falls, it falls as crude rises, and it falls as US yields rise as well. This behavior suggests that investors are getting out of their US dollar holdings and searching for alternatives, and the euro emerges as an interesting alternative for both reserve and funding purposes. I wrote an article on that on Swissquote's blog back in April if you want to have a better understanding of the opportunities but also the challenges that euro faces today in replacing potentially the US dollar in the longer run. So I will leave the link below in the description. But back to our beans. Gold, on the other hand, is another good asset for protection, value protection purposes. The price of an ounce just cleared the 200-day moving average resistance to the upside despite the rising US yields. So we can say that broadly the winds are changing direction. The market narrative changed this week from strong earnings are pushing US and European indices to record high levels thanks to energy, bank, and AI-led boosts in revenues to sovereign yields are rising undesirably, along with the sovereign debt of developed countries, of course, and the whole thing is increasing the borrowing costs around the globe and will end up pressuring earnings expectations and weigh on valuations. And latter narrative is probably here to stay, at least as long as oil prices and yields keep climbing. This week, US retail earnings also pointed to a US consumer base that is becoming increasingly price sensitive and selective, but still spending enough to avoid signaling recession. And for the Federal Reserve, that cooling in spending could eventually help ease demand-driven inflation, provided elevated oil prices don't squeeze consumers further, and could be positive. But unfortunately, no one can guarantee the latter, and no one can guarantee that the Federal Reserve is looking at inflation anymore. What's the point, right? Anyway, the US Treasury's unexpected move on Wednesday stole the spotlight this week, but I don't want to close this week without talking about a big IPO that took place in Shanghai. It's Unitree's IPO. Unitree, you know, the company that produces these so-called kung fu robots that are all over your social media feed, They dance, they fight each other, they tidy up, they dance together, they do spectacles, and they do a whole bunch of stuff actually, and they cost only around 13,500 US dollars for the G1 humanoid. So this IPO took place on Wednesday in Shanghai, as I said, and unsurprisingly so, it drew record demand from investors, around 8,000 times oversubscribed, valuing the company at more than 200 times as sales at the end of the first day of trading in Shanghai, where the stock price soared 460%. The shares fell on Thursday, so the following day, before stabilizing this Friday. Now, obviously, it was very buzzy, and a smaller scale, this IPO looked just like the SpaceX's IPO a few weeks earlier in the US, valuing the future dreams more than today's fundamentals for these companies. So this is why we can see a further drawdown in Unitree's stock price without a clear support target on the downside. I mean, at 200 times the sales, you've got a long way to adjust to the downside. But beyond the euphoria, the humanoid robots are seen as the next big wave of AI. Morgan Stanley today expects the humanoid market to surpass 5 trillion US dollars by 2050, with more than 1 billion humanoid robots potentially in use worldwide by then. 1 billion of these digital dudes. Now, China is the world's champion for the humanoid robots for now, actually accounted for 97% of global humanoid robot shipments in the first half of 2026, while the US lags far behind China in terms of shipments. Yes, Tesla takes a little bit more time than China to produce these robots. Now, other Chinese and US companies also are willing to take a piece of this cake because, well, it's going to be a very promising market. But as an all new and complex technology, the timeline for perfection of these products, of these robots that will serve real life purposes at some point in time to allow mass adoption remains pretty unclear. Companies that could achieve reliable real life use cases and performance, and also attractive returns on investment in large scale industrial and commercial deployments will obviously be the winners in this industry. In the sense, while China's integrated supply chains, its capacity to scale up production, and of course the Chinese government support will likely play in favor of the Chinese peers against the US competitors. As such, I found Tesla's reaction to Unitree's great first day by spiking more than 4% a little bit curious, but Roundhill's Humanoid Robotics ETF, with a ticker that reads HUMAN, I find it quite brilliant, well, fell sharply since mid-August. Now, that ETF is actively managed and includes names like Nvidia, Qualcomm, Amazon, and Meta in it. It changes, but what I'm trying to say is that it doesn't include the robotics companies only, which in the medium run is certainly an interesting mix for investing into the robotics and vertical chain of robotics for those who are obviously ready and willing to shoulder volatility due to high valuations across this industry. Speaking of volatility, I will close this week with the VIX index. The latter has been very low recently, while the companies within the S&P 500 printed pretty big intraday moves, especially if you look at the price moves across technology. So if you have been wondering, like many, how come the latter moves never showed up in the VIX index? Well, one of the reasons why is because these companies moved in quite a disconnected manner from each other on individual factors. And that lack of correlation offered an overall stable view on the index level. The thing is, that could change if the positive pressure in oil prices and yields remain intact or grow and deteriorate the macroeconomy set up for companies at the same time, and the latter could eventually increase correlation among the companies and increase volatility, hence the risk of a further sell-off on the index level moving forward. So with the strong earnings story already baked in, I believe that it's time for deeper correction. Next week, Nvidia will be closing the earnings dance with its own second quarter earnings announcement. But at this point, I doubt that the company has the potential to move oceans nor to reverse the quietly building selling pressure. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.